How to invest your paycheck, a step-by-step guide for young adults. Got your paycheck and wondering how to make your money work for you? Welcome to Adulting 2.0. Today we're diving into simple steps you can take to start investing and make your paycheck grow over time. Let's be real, seeing that direct deposit hit your account is great, but wouldn't it be even better if that money started making more money for you? That's the beauty of investing. Remember, this is for educational purposes only. Be sure to consult with a financial advisor for your specific needs. Before you even think about dropping money in the stock market, we need to talk about your budget. Think of it like this. You wouldn't start building a house on a foundation full of cracks, right? Your finances are the same way. First things first, track your spending. You need to know where every dollar is going. There are tons of apps for that, or you can go old school with a spreadsheet. Next, identify your needs versus your wants. Needs are the non-negotiables. Rent, utilities, groceries. Wants are things you can probably live without or at least cut back on. That daily latte? Yeah, that's probably a want. Once you have a clear picture of your cash flow, you can start allocating your money. The 50-30-20 rule is a great starting point. Allocate 50% of your after-tax income to needs, 30% to wants, and 20% to savings and debt repayment. The key is to be honest with yourself about your spending habits and make adjustments where necessary. Without a solid understanding of your financial situation, you're essentially flying blind. And that's never a good idea, especially when it comes to your money. All right, let's talk about your financial safety net. The emergency fund. This is non-negotiable, people. Before you even think about investing in stocks, bonds, or real estate, you need to have an emergency fund in place. Think of it as your financial peace of mind. Life throws curveballs, unexpected car repairs, medical bills, job loss. You need to be prepared. How much should you have in your emergency fund? A good rule of thumb is 3 to 6 months worth of living expenses. This means if you lose your job or something unexpected happens, you have enough money to cover your essential expenses for at least 3 months, ideally 6. Now, I know that might seem like a lot, especially when you're eager to start investing, but trust me, it's worth it. Having a healthy emergency fund means you won't have to dip into your investments if something unexpected arises. It gives you a cushion, a sense of security. You won't have to worry about selling your investments at a loss to cover an unexpected expense. Start by setting a realistic savings goal for your emergency fund. Consistency is key here. Consider opening a separate high-yield savings account for your emergency fund. Okay, now let's talk about free money. If your employer offers a retirement plan like a 401(k) or 403(b), you need to be taking full advantage of it, especially if they offer a company match. This is literally free money, people. A company match is when your employer contributes a certain percentage of your salary to your retirement account, matching your contributions. For example, if your company offers a 50% match on contributions up to 6% of your salary, and you contribute 6%, they'll kick in an additional 3%. That's a 50% return on your investment before you even factor in market gains. It's like getting a guaranteed return on your money, and you'd be crazy to leave that on the table. Now, you might be thinking, retirement, I just started working. But here's the thing, the earlier you start, the better off you'll be. Time is your greatest asset when it comes to investing, thanks to the power of compound interest. Compound interest is basically interest earned on interest. So even if you can only afford to contribute a small amount right now, do it. Even if it's just enough to get the full employer match, it will make a huge difference in the long run. Plus, contributions to a traditional 401(k) are usually tax deferred, meaning you don't pay taxes on that money until you withdraw it in retirement. Once you've maxed out your employer's retirement plan, it's time to take even more control of your financial future and open a brokerage account or an individual retirement account, commonly known as an IRA. Think of these accounts as your investment playground, where you can choose how you want to grow your money. A brokerage account is like a one-stop shop for investing. You can buy and sell stocks, bonds, mutual funds, exchange-traded funds, or ETFs, and even options. It's a great option if you want flexibility and control over your investments. You can choose individual stocks of companies you believe in or invest in diversified funds that track specific market sectors. On the other hand, an IRA is specifically designed for retirement savings. There are two main types, traditional IRAs and Roth IRAs. Traditional IRAs offer tax-deductible contributions, while Roth IRA contributions are made with after-tax dollars. But your withdrawals in retirement are tax-free. The type of IRA that's right for you depends on your individual circumstances and income level. If you're just starting out, I recommend sticking with low-cost index funds or ETFs. Okay, now let's talk about a strategy that can take the emotion out of investing dollar-cost averaging. We've all heard the saying, buy low, sell high, right? Sounds simple enough, but timing the market perfectly is nearly impossible, even for seasoned investors. That's where dollar-cost averaging comes in. Instead of trying to predict the perfect time to buy or sell, you invest a fixed amount of money at regular intervals, regardless of the market conditions. This could mean investing $100 every paycheck, $500 every month, or whatever amount fits your budget. The key is consistency. When the market is down, your fixed investment buys you more shares at a lower price. When the market is up, you buy fewer shares but at a higher price. Over time, this strategy averages out your purchase price, reducing the impact of market volatility on your portfolio. Dollar-cost averaging takes the guesswork out of trying to time the market and helps you build wealth steadily over time. You've probably heard the saying, don't put all your eggs in one basket, right? Well, that couldn't be truer when it comes to investing. Diversification is key to managing risk and protecting your hard-earned money. Think of your investment portfolio like a well-balanced meal. You wouldn't want to eat only one type of food, right? You need a variety of nutrients to stay healthy. Your portfolio is the same way. You need a mix of different asset classes to reduce risk and maximize returns. The most common asset classes are stocks, bonds, and real estate. Stocks represent ownership in a company and offer the potential for high returns, but also come with higher risk. Bonds are like loans you make to governments or corporations, offering lower returns but generally considered less risky than stocks. By diversifying your portfolio across different asset classes, you're spreading your risk. Here's a little secret to supercharging your investment returns. Reinvest your dividends. Dividends are payments made by companies to their shareholders, typically in the form of cash. They're like little bonuses you receive for owning a piece of a company. When you reinvest dividends, you're essentially buying more shares of the same investment. This means you're putting your money to work, earning you even more money over time. Think of it like a snowball effect. As your investment grows, you receive more dividends. You reinvest those dividends, buying more shares, which then generate even more dividends. Over time, this compounding effect can significantly amplify your returns. Many brokerage accounts and IRAs offer dividend reinvestment plans or DRIPs, which automatically reinvest your dividends for you. Now, before you rush off to open accounts and start picking stocks, there's one last crucial thing we need to talk about: patience and consistency. Investing is a marathon, not a sprint. It's about making smart, informed decisions and sticking with them for the long haul. Don't expect to get rich quick. Anyone promising you overnight riches is probably trying to scam you. Building wealth takes time, discipline, and a healthy dose of patience. The stock market will have its ups and downs. There will be times when your portfolio is soaring and times when it's taking a dip. The key is to not panic and make emotional decisions. Remember why you're investing in the first place: to grow your wealth over time. Stick to your plan, stay consistent with your contributions, and let the power of compounding work its magic. The most successful investors are those who stay disciplined, ride out the market's ups and downs, and focus on the long term. That's it for today's episode on how to invest your paycheck. Remember, investing is one of the most powerful tools for building wealth over time. By following these steps, you can put your money to work for you and create a brighter financial future. Make sure to check out our other videos on managing your finances, building wealth, and more. Like, subscribe, and hit the bell so you never miss out on our next guide to adulting.